I see some familiar faces out here, and I'll remind them. First of all, I'm going to say this mic is to record this so that this is going to be on the website. It's not broadcasting to you. You're going to listen to my voice, and this is going to go into the recording. But for these guys from 74, I do have chalk up here. If you get out of line, boom. We're going to, in very quick order, talk about reducing risk in volatile markets. And that's the type of thing where I was telling somebody at breakfast, I could probably do a whole semester on the topic of risk and have one class for each form of risk. So this is going to, by necessity, be quick, elementary school level. I am going to try to give everybody at least one idea they might be able to take home with them and use for their own portfolio. As Sal mentioned, I don't have an axe to grind because I retired 11 years ago. So I have two clients, this cute blonde over here and myself. And this is Brenda, my wife. Let's hit it. I want to get a show of hands first, just for fun, and just to see what everybody thinks about which investment is most risky. So I listed a bunch: the treasury bond stocks, crude oil futures, Japanese yen, real estate, and an annuity. So let's just go down the list. Quick raising hands on, you select which one you think is the most risky, and then you raise your hand when we get to that item. So let's start with treasury bonds. Any hands for treasury bonds being the most risky? All right, we have one. Stocks, raise a hand. One in the back. Crude oil futures. There's a couple here. Ooh, we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Japanese yen. Whoa, 1, 2, 3, 4, 5, 6, 7, 8, 9. So crude oil futures was a little ahead. Real estate. Whoa. Must have been through the recent downs. 2008, maybe rental property. Annuity. Oh, yeah, 1, 2, 3, 4. Okay, boy, that was interesting. But in the nature of money management, we're going to learn a lesson. Labels don't mean a lot. I didn't tell you how I was going to manage those instruments. If I am a known money manager and I go to my favorite broker and say, guys, I'd like to go buy for my hedge fund some treasury bonds and lever it 10 to 1. That would be pretty risky, right? If interest rates go up a little bit, I could be wiped out very fast. How about stocks on full margin? Especially if I did penny stocks or small stocks. Crude oil futures, I was going to pay cash for them. That would be like almost watching paint dry. It would be very, very not risky. Japanese yen, how about if we 50% lever that? It wouldn't be that risky. Probably a little more risky than crude oil futures, the way I described it. Real estate, I was going to do rental with 0% down. My real estate expert over here would tell you that's risky. Annuity from a small company, C- rated, could go out of business. So the four guys that selected annuities nailed that one. But it all depends on how you structure it. So let's get right out of the gate. Everybody should learn here that when your broker, financial planner, fill in the name, whatever he or she is, tells you something that has a name like annuity, I'm going to talk about an annuity, I'm going to talk about futures or whatever, don't run scared just yet. You want to know how they're going to structure it, how much leverage there is, and so on. Very important. Diversification is very tricky. If you look at this, I just took off of a screening done on a free service. I think it was Schwab.com I took this one from. And I took the 4 largest growth stock mutual funds in the country off the screening, all by different firms, different money managers running the money. Well, look what happens. The market goes down around 2008, 2009. All 4 of those go down. Same thing happens during this little downswing and that little downswing. You see the spikes, they're all together. If you have these 4 things in your portfolio, are you diversified? No, you are not. You got 4 of the same thing roughly, give or take a little bit. Make sense? So be careful. The lesson here to be learned is if some financial planner says, oh, we're going to give you this mutual fund and that mutual fund and that mutual fund and that mutual fund, you better look and see whether Go back and take one of your services. I think Yahoo Finances, you can do this for free. Lots of services out there you can get on the web. Just take those ticker symbols of those mutual funds that this person's recommending to you and draw a 10-year graph on them and just see if they all line up together. That's going to tell you that, hey, if the market goes down 50% or so like it does in an area here, hold on to the chair, brace yourself, it could get rough, okay? Don't delude yourself into thinking you're really diversified. So problems with true diversification. It's tough to find it. You've got lots of different instruments out there, but it's very difficult to get every one to be independent of every other one. You can't just buy 10 growth stock mutual funds. I just showed you. Another one, correlation shift over time. You got times when precious metals will go opposite of the stock market, and then there's other times where precious metals will go the same way as the stock market. So in one case, it's not diversified, and it's a wonderful diversification, and then the next time, it really isn't any diversification at all. So every day, you're either making money or losing money, and all of those vehicles are acting together. So the correlation shift over time is very difficult to deal with. Negative correlations sound good. Hey, this goes up, that goes down. That would be a good thing, right, for reducing risk? Only problem is you can't make any money that way, because if I'm making 10% here and losing 10% there, what have I got? Nothing. Zero. That's not any good. The other thing we found over time at Trendstat, back the firm I had before I retired, investments are very correlated in times of crisis. So all of a sudden you get the word that we're invading Iraq to protect Kuwait. The first time around, that would be HW. Overnight crude oil goes from 32 to 40, and by the time I get in the morning, it's at $22 a barrel. And you look at all the markets that day, and there was markets just shutting down. And I'm looking at the computers, and every one of them is moving very large in various directions. But once they establish that, they're locked together. And it's a term we called lockstep at Trendstat, where every market is lockstep to another market, and there's no diversification. Wherever you are, and you hang on for dear life. It's hard to deal with it. Hard to ever anticipate how that's going to happen in the time of crisis. So that's a difficulty. And you in the United States, and I operated around the world, but in the United States, because of trying to protect everyone in this audience, sadly, you can't always get diversification with one type of investment account because the laws make it hard. An example, I was on the board of the National Futures Association, which regulated the futures industry. And I represented the commodity trading advisor side of that industry. That's what I was, one of the things I was. And so I could trade futures, but I'd need futures commission merchants, and I'd need exchanges like the Chicago Board of Exchange and the Chicago Mercantile Exchange and the Chicago Board of Trade, excuse me. But then over here in another part of my business, I'm an investment advisor registered with the Securities Exchange Commission, and there I'm putting orders through the Charles Schwabs of the world or the Fidelity Investments of the world or Merrill Lynch's of the world, and I'm monitored by the Securities and Exchange Commission. And I can't get, by law, this stuff over here to be in the same account as that stuff over there. So I have to have two accounts, which then drives clients crazy. It's very, very difficult for the client themselves to even deal with it. You've got all sorts of paper coming in every month. It's a mess. So sadly, the laws in the United States, if I'm offshore, I can do that all day long. They don't care over there. But when you're in the United States, you have to try to think through the fact that you might have to go to different places to get true diversification. Now here's forms of risk to look for, and I thought of another one this morning when somebody was saying, I had this guy that was in San Francisco, and immediately I thought, I didn't put up earthquake risk. That would be another one. But market risk is just, say, the stock market going up and down. And as we saw back in the 2008 time frame with those 4 mutual funds, if the stock market generally goes down, generally speaking, a lot of stocks these days will go down. And why is that? There's a lot of, computer trading and things, but, that's going to happen. You got individual company or contract or issue risk. So a specific municipal bond might have the city that it's based on go bankrupt, and then you have to deal with the trustees and figure out whether you're going to be able to get anything out of it. So there's individual risk of the specific issue that you bought that may also be affected by the market itself. Bonds go up, your bond goes up. Risk of volatility, that's the risk of something moving. And you would think, is that really a risk? Well, I would submit to you that everybody in this room has emotions and psychology. And if I give you something that I was going to get at the end of every day, trading day, I'm going to give you a report in how, like, your portfolio went up 5% today. Tomorrow it went down by 10. And you're going, whoa, that's moving all over the place. Now, maybe over the 2 years that we'd manage it, maybe you're up 100%, and you'd say, oh, that's okay. I like that. You'd never make it that far, because between now and then, you would be so rattled, and you wouldn't be able to sleep at night, most people. So volatility becomes a form of risk. Having no volatility, like a CD, you can sleep very well at night. It doesn't move around at all. Real estate, to a lot of people, is kind of the same thing, but as some of the real estate investors and my wife would tell you, real estate goes up and down. You just don't see it in the Wall Street Journal every day. It just, it's still moving. The risk of inflation. The government keeps telling us we don't have inflation, but they keep changing the benchmarks that they use to measure it conveniently. If you look at the price of some foods in the grocery store, and Brenda and I both cook, so we take turns going to the grocery store, you can see that we're getting some inflation. And hogs and cattle are going crazy on my commodity account, so I know that those are going to be costing more in the future. So if you don't increase your portfolio to deal with inflation, you're losing ground there. That's a risk. Especially a lot of the people a little older in the room, we're living off of our portfolios in retirement. You got to keep up with it. Risk of currency. Currency is the US dollar here. Most of the people in the room, if we went in your wallets, you'd pull out greenbacks. If I was doing the same talk in France or Germany, it'd be euro. The value of what's in your wallet has a certain amount of ability to buy a certain amount of stuff. If what's in your wallet diminishes in its value, you have to pay more of them to get the same stuff. That's a risk. There's legal risk. Legal risk would be all these things like you buy a stock in a company, small company, and now they get sued for avoiding a patent that they should have paid billions of dollars for, and so now they're going to go out of business. That would be a legal risk. Or another form of legal risk would be signing for something and ending up having a money call or something like that. Let's go into each one and try to give you some little more detail on it and see what you could do with it. Now, market risk with computers, market risk it'll affect you whether you want to acknowledge it or not. What I mean by that is every day out there, hundreds of millions of shares, sometimes billions of shares are traded. And there's a lot of guys that are far better than I was with computers. They have bigger computers. They're right on the street. They are going to be able to buy 1 second and sell in another second if they want to. I'm not saying they do. Probably be stupid sometimes, but they could do it. The point is what used to take back in the 70s when I came out of college and started getting more into investments and learning a lot about it, we didn't even have IBM PCs then, if you remember. They came around about 80, 82 area. I think I bought my first PC. So now you've got, in the old days, calling people up, orders being written down, that being transmitted to the floor guy has to walk over someplace, execute the trade. I mean, 15, 20 minutes goes by before the thing's, now, I go on Schwab.com, I could be in Italy, go on Schwab.com, hit a button, and the thing is executed in New York a few seconds later. So it's going to affect you. You might as well embrace that because it's there. It's the way the world works these days. It's also possible to stop out of positions to protect values, then get back in. We were just talking to somebody at breakfast who was in a big position, and he noticed that every time it went into earnings, it always got insanely volatile because everybody was trying to guess what was going to happen. And he finally decided, you know, my accounts over here at Schwab or someplace cost me $8 to buy whatever amount of shares or sell whatever amount of shares I want. You know, he could literally sell $1 million worth of XYZ, and then 3 days later, after the thing gets very volatile, for $8, he can buy 1 million shares of XYZ back. So he can sell it out and buy it back, adjust your risk. If you sell the position out and it goes to cash or money market, how much risk do you have? You have the risk of the money market fund maybe, and its values and its issues and whether it could go bankrupt or not, but you're not going to get a lot of fluctuation in a money market fund. Stock, especially during earnings, could be very volatile. So he started thinking, you know, I would be smart to reduce my risk by just selling out here when I thought it was fine, go through the earnings and buy it back cheaper if it got volatile. Now, whether he did that or not, and considering tax consequences and all that, a lot of other side issues, but it's something to think about because in today's world, the cost of transaction has been so minimized by computers versus the way we were taught when we were coming out of college. You know, buy and hold, cost of commissions was $100 for a 100-share lot of maybe $90, something like that. To do 100 shares of XYZ, you would pay $90 sometimes. Well, now it's $8 for as much as you want. You could do $10 million worth at $8. It's like having no cost at all. So think about reducing, think about getting in and out of things a little bit more to try to position your risk the way you feel comfortable. Using market hedges. Now here's something that I do myself for Brendan and me. And it's pretty easy to do. If you've got a portfolio of various stocks on the long side, this is going to get difficult because I got to hold the mic because they're recording it, but if you look at, my palm is facing upward on this. This is where the profits as we go up with our long position of stocks, we're going to make money this way, all right? If I could put in position another like stock, ETF, exchange traded fund, mutual fund or something that was going to make money this way, and if I put those two together, which is impossible to do now, I'm going to go this way. What we're going to do is go down and go up, and they're going to equal each other, or roughly equal each other. And what have I done? For that moment of time when these two things are in place, I have counteracted risk because if both go up, I'm losing here, making money there. If both go down, making money here, losing here. If I can get them to equal each other, I've taken myself out of the market. Only I haven't. These positions are longs. They're building up long-term capital gains over the long run. I'm riding through every downswing, but I'm taking away the potential for getting clocked by this hedge that I'm putting on and off. So if anybody wants to subscribe to either my Twitter feed or my Facebook feed, you will find that for all my 500 or so trader friends out there, I always tell everybody as near as I can. I was on the road coming up here when a signal went over on Thursday, actually, to the downside, and I put my full hedges on Thursday. Now, whether that'll be a smart move or not, who knows? That's what my indicator said. That's what I did. I didn't think about it. But the point is, I may take those same hedges off this next week sometime, but in the meanwhile, I'm pretty much out of the market for the next few days. Don't have to worry about it. I sleep great at night. All right? Just an idea. And a lot of you have IRAs or pension plans. I use short sales in what's called an SPY. That's a ticker symbol for what I think is a SPDR, Standard & Poor's 500 index. So when I short an SPY, I'm essentially taking a short sale position, making money to the downside in the Standard & Poor's 500. But if you can take like an SPXU, which is a different exchange-traded fund that is flipped upside down, so you can buy it, but it's really a short in the Standard & Poor's 500. You can put those in an IRA. You can put them in a pension plan, buy them long like any mutual fund or exchange-traded fund, and still get risk reduction. So that's something to look into. I don't want to get into a lot of detail. At the end of this, by the way, I'm going to give you all my email. Any questions you have, fine with me. Bring them on. Individual issue risk. This is something where if you get into exchange-traded funds, mutual funds, groups of where they put together hundreds of stocks, you're going to get rid of a lot of this. So that's one easy way of taking care of this. But if you insist on going into an individual issue, your friend at the country club says, oh man, this stock is really good, do some research. Make sure the issue is financially sound. If you can't do it, have somebody do it for you. Every one of us knows a CPA or a friend, a cousin that has done a lot of financial analysis or something. Ask him to do you a favor. You know, give him a bottle of wine or take him out to coffee someday and see if you can get somebody to pick apart the goods and bads. I've done this for a lot of people. I've got so good at it that basically people can send me some literature and it takes me about 15 minutes to pick apart the key things of where the costs are going, where's the money going. I mean, these legal documents are this thick. Believe it or not, all you clients of all the financial services firms in the country are paying for all the money managers like I was to give you those darn legal documents. And I'd say 90% of you have taken those. If we're lucky, you stick them in the file. Most likely, they go into the waste paper basket. And they cost huge sums of money to produce. People don't read them. There's a lot of good information in there if you'll take the time. So on some quiet Saturday morning, grab another cup of coffee, sit down in your comfortable chair, and try not to fall and browse if you have to. But there's some parts you'll learn that you can kind of get through a little quicker, and some parts you might want to spend a little more time on. Minimize the individual risk by sticking to mutual funds and exchange-traded funds. The SPY, Standard & Poor's 500 index fund that I was talking about just a little earlier that I use for hedging is literally 500 stocks. So if you buy that, you own 500 issues. Any one of them going bankrupt, you're not even going to notice it. And I like to follow my price up with stop sell orders. In the world of computers, you can look and you can put a stop sell, good till cancel, right behind the issue, so that if I have a stock going up like this and I've got a stop down here and it goes up some more, I can move the stop up to there, moves it up, I just keep moving it up. Sooner or later the stock's going to take a downswing, it's going to hit my stop and I'll be out. Fine. I'll lock in the profit along the way, I don't have to worry about it. Come down to the end of the day and it takes care of it. Risk of volatility. I'll say this. Volatility, I was telling Michael up there, back in the day when I first started in the business, people would say, you're in commodities? Isn't that dangerous? And I smile every morning when I wake up now at 6:30 or so out in Phoenix, Scottsdale area, and I look at my computer and the Standard & Poor's or the Dow Jones is up 1% off the open. And I'm thinking, that seems awfully risky to me. People were telling me I was trading crazy stuff, and it was a rare event to have our futures accounts ever move by more than 1% a day. But it seems like the stock market can do it every other day these days. So volatility has gotten a lot greater. I think computer trading allows it. You know, it took, in the old days, a bear market would be a few years long because it just took that long for everybody's psychology to change and for people to finally get frustrated and get out of the market and say, I'm never going to buy stocks again, and then it would turn around and go the other way. And then right at the top, they say, oh my God, I'm missing it. I got to get back in. And it took several years for that to happen. Nowadays, it takes about 2 weeks because computers move everything so quickly. The largest ingredient of volatility in your own portfolio is going to be leverage. If you put things on margin, if you go futures and put very little bit down, currencies, very little down, real estate, very small down payment, all of those things are going to increase the volatility that your portfolio goes up and down. So if you want to reduce risk in volatility terms, look carefully at how you're leveraging your portfolio. That will just drop your ups and downs and smooth things out. And when you smooth things out, you'll smooth your psychology out as well. You'll start making better strategic decisions rather than emotional ones based on how much you made or lost. I mean, I think it's dangerous both ways. If you get a leverage going and you come into Friday afternoon and, man, this position you bought just, went up 5% in the day and you had it leveraged so it's really up 10%, I mean, you're ready to go celebrate. That's as dangerous as the other way around, losing the 10% and then being depressed over it. because you're too high or too low. Good money management, good portfolio strategy should be sort of keeping your emotions on a long-term even keel, not trying to be high or low. And that's where you're best served. Inflation risk. Federal Reserve is drastically increasing the money supply. That probably bodes for a future devaluing of the dollar, whether we like it or not, because if you put more paper backing the same amount of assets and net worth, it's probably going to not be a good thing for the dollar. And this is a concept that I've used over the years that I think people can understand. Increase your net worth to protect your net wealth. Net worth, assets minus liabilities equals your net worth. Everybody has one in the room if you want to go through that exercise. That net worth today would buy a certain amount of goods and services, stuff. That's your net wealth, right? Now let's say a year goes by and we're back here a year from now and we're talking and everybody's net worth magically stayed the same. But you can't buy as much stuff with that net worth. Your net wealth has declined. So you're trying to increase your net worth to try to just hold on to being able to buy the same amount of stuff. Hopefully, if you get lucky, you can even buy more stuff. But at a minimum, we're going to strain and struggle to keep up with it in coming years, I believe. So try to think about not staying the same in terms of dollars. Try to keep increasing it just to try to be able to make ends meet and buy the same stuff. I don't think anymore you can save. My father was a saver. He did CDs. He passed away back in 99. I think he had maybe 60,000 in his IRA. Doesn't cut it anymore. You can't just go buy CDs, put it in a money market fund. It sounds easy, sounds safe. You're going to lose to inflation. You're going to lose to dollar devaluation. You're not going to be able to afford to pay for food and shelter down the road. So you got to think about investing whether you like it or not, and sadly, that's the way the world seems to be. Although there's one thing, I would lean to the long side in today's world, and the reason why. Assets are based in dollars. If the dollar becomes less valuable, it's going to take more dollars to buy the same stock, piece of real estate, whatever we're talking about, gold. Because the dollar becomes less in purchasing power, it takes more of them to buy the same thing. So without even having if a company's making $1 of earnings a share, and it sells for a price to earnings of 10, then it's going to sell for a stock price of 10. But if inflation knocks down the value of the dollar and the company has to make $2 just to break even and make somewhere around the same amount of money in real terms, the stock's got to sell for 20. Well, if you bought it at 10, it's now worth 20. You just made 100% on your stock. You didn't get any ahead a whole lot, but you did make 100% return on your stock. So you're really trying to increase your net worth to protect your net wealth. And I'd lean to the long side because I think dollars devaluing are going to lead you that way. Currency risk. We've got U.S. dollar fluctuating. I think a lot of people in this room, I suspect, have been out of the country at least one time in their life. Some of you I've talked to have lived in other countries, so you know what I'm talking about in spades. And I traveled a lot too, and get to the airport, change the dollars and into something, and take a hit on the bid-ask spread, and then you got to pay for the taxi and on and on. But the U.S. dollar fluctuates a great deal against other currencies, and that can work in your favor or not. I remember buying a Toyota or what was it? It was a Lexus. We had bought for about $35,000, and about 4 years later, we were in the Lexus dealer trying to get a repair job done. So I'm killing time. I went out in the sales room. Salesman comes up and says, "Can I help you?" Yeah, I want to see this 400 over here. We have a car just like it back in the shop, and really like it. I just want to see how the new ones are going along. He said, "Well, it's fine. It's $52,000." And I said, "Well, what has changed from the year we bought ours and this one?" He said, "Well, we've got more plastic over here, and we've cut off this much space. Gas mileage is up about 2% or 2 miles per gallon. Blah, 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 blah." And I'm thinking, wow, is that worth, let's see, 52 minus 35 is like $17,000? He said, "Well, increased gas mileage, better efficiency, engine, blah, blah, blah. I went back the next day. I went to my computer databases, and I pulled up the Japanese yen US dollar exchange rate. And almost to a percent, the dollar dropping was equal to the price of the Lexus going up. In other words, Toyota, which owns Lexus, has to pay their workers in yen. If we have cheaper dollars, they got to have more dollars to pay the same amount, not even give their workers a raise. So they have to increase the price to compensate for that. You're going to see that in the future a lot if the dollar gets hit versus other currencies. And that's going to affect your net wealth. Now, some world ETFs is a way that you could try to buffer your risk. There's exchange-traded funds out there that will be concentrated in, say, India or in the Pacific Rim or in the Euro world. And there are small capitalized companies and there's large capitalized companies and there's bond funds. But a lot of these, if you want to diversify around the world, you're going to have to make sure they're denominated in that country's currency, because a lot of U.S. managers, knowing that they have U.S. clients, think that their clients want to see a U.S. value there, and so they'll hedge the currency or play games with it, convert it somehow. You're going to want to try to find something that's a pure play in the local currency, if you can find it. And there are some out there. You just have to look for them. And again, a lot of the Yahoo Finances and other things, there's lots of free services that'll do mutual fund screens for you. So that'd be another way to try to get that. The other thing you could do is what I do is actually trade foreign currencies. Not that hard to do anymore, but you would have to have a futures account, and that would be a little bit intimidating on lingo, and you'd have to learn something. But if you're open to learning something, there are ways of learning it. I was not born with a knowledge of currencies. I had to learn it, and you can too. Legal risk, the final one is read the paperwork. I mean, we send it to you for a reason. You might as well, get the thing. If you need advice, there's lawyers that'll read it for you, or again, somebody like me that you know in your life that you can plead to, could you just check this out because I don't understand this stuff or whatever. Or you can actually try to understand it yourself. It's an acquired skill. Be careful signing letters of credit or lines of credit, because sometimes those are actually called on and you might get a big surprise down the road. Stick to investments that are audited. I cannot tell you how many times in my lifetime I've either been in court as an expert witness for people like you, suing their brokers, or family members, friends, you name it. I hear these sob stories about, yeah, I gave this guy my money for this deal. He had this restaurant he was going to open, and he's going to do this and that, or a development, and all of a sudden, the development didn't happen, the restaurant failed, or whatever, and he's now no longer to be found. He's left the state with my money. And what do I do? Well, what do I do? I don't know. Hire a private investigator to try to find him? The money's gone. You've given your money over in control to somebody else. When we managed money, people would put the money in an account and give us limited power of attorney to buy and sell for that account, but I could not get to that money. If I could, that institution that was holding it would be sued out of business. So you have cross-checks and protection. This institution can talk about me. I can talk about them. The client's protected. Try to stick to those types of relationships, at least if you're going to do a small deal. Make sure there's audits periodically. Make sure there's somebody else maybe in control of the actual cash if you can figure out how to do that. Or get involved personally yourself so you can keep your eyes on it really closely. It's a dangerous thing to do, to give somebody else control of the cash, because they can walk away with it. Always remember that. And and at that point, I have two things to announce. There was a yellow pad going around the room. I wrote a book called, at first, The Frustrated Investor, which, by the way, this was the cover of it. And Frustrated Investor was my kind of attempt to try to help my clients understand the process of good investing. I have several boxes of those in my garage. I self-published it way back in the 90s someplace. you can see what I looked like in the 90s. It's very different than my look now. I had glasses and all weird things. Because I have those, and because Sal has a mailing address, if you write down your name, address, and email on that yellow pad, he's going to take it. I'm going to ship a box up to him, and he's going to ship them out to you for attending the talk. For whatever help they are, that's good. If you have any comments about the book, send them on. Wiley and Sons saw the book at some kind of conference I was at, and immediately the Wiley and Sons head guy came running over to me and got a hold of me and said, I need to have a meeting with you. And he wanted to pick up the book's rights. So I can't sell Frustrated Investor. I can give it away. Probably shouldn't even be doing that, probably, but if you ever want to buy the new, let's see, extra chapter plus an appendix is all that's the change. Maybe some slightly different graphics, I think, in one case. That's available at Amazon, called The Panic-Proof Investing. Panic-Proof Investing is the name of the new book. Wiley didn't like Frustrated Investor. They thought it was too negative. That's one thing. Second thing is I've put up right here, tom@trendstat.com. I held on to my URL to this day, even though I've been retired for 11 years. That was the name of my money management firm, Trendstat Capital Management. Because I have a very well-known email address, and I have traders all over the world that probably once a day ask me questions about all sorts of things, from India to Japan to Britain, they're all over. Some are a little more active in their questioning than others, but believe it or not, within about 24 hours, I can get back to most people on those questions. And it's one of my things I enjoy doing in retirement. I don't have an axe to grind. I don't have a firm anymore. I don't sell anything. But it's fun to keep in touch with people and help people out. So I do it totally for just fun and keeping myself sharp about investments. So if anybody has any questions about anything, or you're considering an investment and you're a little nervous because of 1, 2, 3, 4, you can put it in an email to me or attach a copy of something and say you went to a presentation at Clarkson and would you mind answering this question, and I'll see what I can do. And with that, I'll take questions right now from anybody. Mr. Paul.